I think it's probably more compelling, but I love that idea. I mean, and by the way, I love this conversation. I'm in my 30s or 40s, but not 50s yet. But I think that's exactly right. I think you want to layer into fixed income, right? You can buy some cash. Cash is great. 4% is fantastic. But if you're paying taxes, municipal bonds are going to give you, 4.25%, I think, for things that mature in the next 5 to 10 years. If you pay a decent tax rate, that gets you 6-7% equivalents.
Wow.
If you like high yield, then yes. I mean, you can get 6-7% equivalents there too. So it doesn't mean we're at the bottom. It doesn't mean we're going back to 2% 10-year notes, and it doesn't mean the Fed has to ease, right? But what it does mean is income is part of the story, whereas, as you said, the last 5 years, it really wasn't there.
What are we missing? Because, a couple years ago, crypto looked like a sure thing, and everyone felt like a genius for 6 months until it collapsed. If fixed income looks like this much of a sure thing, are we all missing the fact that the Fed's about to surprise us again and destroy this whole party by hiking and ruining returns again? What can we be missing here?
Yeah, I think it's interesting, right? You look at the bond market, it's sure about a couple things, that the Fed is almost done hiking, they're going to ease. And by the way, it's very sure that inflation is going back to the mid-twos, right? Five-year break-evens near 2.5%.
Yeah.
So the risk is that persistent inflation and the Fed keeps raising rates. But again, if you buy some cash assets, 1-year things that mature, if you're wrong, you can re-up at a higher rate. And the yield curve is telling you, by the way, long-term, the Fed's going to get this right. So growth is going to suffer, it's going to go down, inflation will eventually be conquered. So I like buying some very short-duration things and then some yieldier things that are in that 10-year part of the curve. It doesn't mean you win right away, but if you buy it over time, if you're wrong, you'll survive. By the way, if you're wrong, I think equities have a harder time, not an easier time.
Right, exactly.
Well, so Kelly, I mean, to that point, there's a sense growing right now. I mean, first of all, if you're a fixed income investor, the two biggest things that you absolutely fear, are default, first and foremost, and then inflation, probably a distant second, or maybe a close second, if you want to look at it that way. The biggest wild card in the coming year to 2 years is whether or not central banks here in America and around the world will be able to get that inflation story in check. Because when it comes to sovereign debt, it's not really about the default aspect anymore. Certainly not for the U.S. and other double, AAA rated kind of countries out there. But if inflation is going to be a persistent story in the coming years, it takes away a lot of the allure of that fixed income kind of investment. And all of a sudden, you might start to see things change a little bit. Maybe not back all the way towards the TINA trade, right? All into stocks because there is no alternative. But people will maybe focus a lot more on risky assets just as a frame of thinking because they feel as though inflation is going to be part of the story for a long time.
And I guess maybe, Brian, we'll leave it with you on that note. So if the Fed fights inflation and protects you that way, they risk a downturn that could wipe out your credit if you're exposed to default risk. If they don't fight inflation enough, your companies might pay out their obligations, but you might come out behind on inflation. So those are kind of the tug of war we're in.
No doubt. That's the risk. The risk is inflation stays high and your yields aren't high enough. By the way, you could put tips into your portfolio. We're not pricing inflation. So, yeah, this isn't a call for take 100% of your money and put it into bonds. This is it. There are still risks out there. But as part of the discussion, should I own some? The answer is yes. And then we're going to figure all this out in the next couple of years. The bond market is, I think, very much at odds with a lot of other opinions out there in terms of inflation coming right back to where it's been the last decade. But we'll find out.
Yeah, you mentioned munis, Brian. You mentioned kind of short-term. Any kind of last opportunities you just want to name call for people who are doing some research on their own at home?
Yeah, listen, the place where we've seen the most inflation fighting is in emerging markets, right? It's been a tough decade for emerging markets, but if you want to see yields that are really high, you can go look at emerging market debt funds and find real yields that are high. Countries that are fighting inflation, I think, very successfully. It's been a tough trade, but one worth looking at. A creative emerging markets funds. I don't think you want to buy the index and things like that, but I think a combination of emerging market local debt and emerging market dollar-denominated debt, there's just some great opportunities in there. It's been kind of forgotten about.
We went from boring, safe Treasury fixed income to emerging market debt, just like that.
Wonky, but
just
wonderful.
Like that. Yeah. It's part of the conversation.
Wonky, but wonderful, Brian.
Brian,
Wonky,
thank you very
wonderful.
much. Brian Weinstein with Morgan Stanley. Dom, a huge thanks as well. Dom Chu.